Hi, everybody. Welcome to today's accounting design project. Today we have Alan Huang from Hong Kong HKUST, along with Shihen, his co-author, and the title of the paper is Determinants and Consequences of Financial Thresholds in Credit Ratings. Alan, the floor is yours.
Thank you, Yang, for the introduction, and very happy to be presenting this paper here together with my co-author Huang and Bugua, who will join momentarily. So for the paper, the title basically describes what we do here. We are looking at the determinants and consequence of financial thresholds in credit ratings. So this is a very typical credit rating reports. Credit rating and credit rating analysts is not a area that most people are familiar with, unlike equity reports. So I'll give you a brief walk down of what a credit analyst reports look like. Now, there are three large credit rating agencies in the world: S&P, Moody's, and Fitch. And this is a very, very typical credit rating reports from S&P covering a company named American Tower Corporation. Now, the first thing you will see here is that it's a very, very structured format of reports. So unlike equity analyst reports, which tend to be very freestyle and they are issued based on impromptu information, and the analysts can say anything they want in any parts of the reports, the credit analyst reports follow a very structured format in the sense that they cover the table of contents here. They will have an anchor and rating results. They will almost always have rating rationale, outlooks, base case scenario, company description, business risk, financial risk, etc. Now, this has to do with the purpose of credit rating reports and also the purpose of the rating itself. Now, I want to highlight one part in the credit rating reports. That's the outlook section. So even though credit analyst reports can talk about what has happened in the past, they always talk about what they believe will happen in the future as well, and under what scenario in the future they might change their ratings. Now, this is to provide some guidance to the users of credit ratings so that they can anticipate any changes in the ratings and under what scenarios those changes might happen. So this is a very typical session of a rating reports outlook session. The outlook session would start with an overall brief overview of what they believe the company's credit scenario would be, and then it would go down and cover some of the upside and downside scenarios. So in this report here, the outlook is stable, so they don't expect the ratings and the credit criteria of the company will change over time. We expect profitability and cash flow to remain stable and increase over the next few years, et cetera, et cetera. And interestingly, they also look at a downside scenario and upside scenario here. So a downgrade is not likely in our view, but could occur if the company were to adopt a more aggressive financial policies, including certain conditions. Now, this is also where the financial ratio is often used. So in this particular downside scenarios, the rating analysts discussed that they could downgrade the stock if the leverage were to remain above 6 times or higher, or FFO to debt were to drop to less than 12%. So if you think about these two conditions here, and by the way, if you feel free to interrupt me if you have any questions, either unmute yourself or raise your hands. I would call out. I don't need any uninterrupted time here. So if you look at these two scenarios, these are accounting ratios based on financial statement numbers that the credit rating analyst has pointed out that under these scenarios, they might downgrade the company's stock. Might downgrade the company's credit ratings or provide negative credit rating actions. So these type of downside and upside scenarios, especially using the financial thresholds, were a very recent scenario. So this is a graph based on the percentage of reports that contains what we looked at before, the core ratios-based thresholds in S&P reports, which is what we use in our study here. As you can see, in the beginning of our sample period, so around 2007, 2008 period, there were very, very few reports, less than 10% in 2007, that actually contain these financial ratio thresholds. So before that, company analysts almost never discuss their ratios in the downside scenarios in the reports, but it has significantly increased over time, with the largest increase coming right around the time of financial crisis. Now, this also happened to be the period that the credit rating analysts were under severe criticisms for the black box in terms of their rating methodology and also in terms of the conflict of interest that the Congress and all the other investors have put the blame on credit rating analysts during the financial crisis period. Now, the ratio remains stable after about 2010, 2011, and right now, about 70 to 80%. In 70 to 80% of the reports that are issued by S&P, they contain at least one of these two core ratio-based thresholds. A very similar downside sort of trigger that we see is covenants, debt covenants. So in debt covenants and rating thresholds, these two are both conditions under which that affects companies' ability to raise debt and affects debt investors. Now, these two are targeting different audience and they are issued by different people. So I would like to give a brief discussion about what are the differences and also the similarities of these two type of downside thresholds. So first of all, private debt covenants, they are binding agreements between the creditors and the borrowers. And these two they are contractually enforceable. They have direct and immediate economic consequences for the borrowers. Now, the binding agreement part, first of all, the binding part means that they are contractually enforceable. And second, the agreement part means that for debt covenants, these are after negotiations between the creditors, and so between the lenders and the borrowers. So any time that a covenant is included in a debt contract, the company itself must agree to that. Now, and the immediate and also direct economic consequences for the borrowers, if a firm is violating covenants, they are in default. And even when the firm is close enough to the covenants, usually there will be a renegotiation of the debt contract, etc. But for the rating thresholds, they are more of a probabilistic assessment of the credit risk, and the users of them and the intended user of them are not just the company itself, not just the borrower lenders, but also these are public information that serve as a signal to the public debt market participants. And as we see later on, if you look at the debt covenants, if you look at the rating thresholds, when a firm violates the rating thresholds, when a firm breaches the rating thresholds, the credit rating agencies might take negative rating actions. There's a much higher chance that they take the negative rating actions, but it's not even close to a default, not 100%. So it's a higher likelihood, but it's not a guarantee. Now, in terms of the incentives, private lenders, they have very strong economic incentives because it's their money on the line. They put their own financial stake, invest in the companies. So they want to monitor the companies very, very closely and not lose their own capital. But if you look at the issuers of the rating thresholds, these are credit rating agencies. Credit rating agencies don't really invest in the debt themselves. Although they do have incentives, the incentive is more of a reputational credibility and also to help them with future businesses. So they're trying to fulfill their role as information intermediaries. And lastly, for credit rating agencies, they operate under issuer pay revenue model. So even though they are paid, they're not paid by the investors, they are paid by the borrowers. Ayang, please go ahead.
Yeah, I'm just kind of like want to know that a little bit more about the issuer pay revenue model. So I think we see that in the private deal scan kind of private loan populations, that not a lot of those contracts actually the borrower actually has any credit ratings. So can you kind of shed light a little bit on usually what kind of issuers will actually pay the CRA to actually issue those reports? And is there any other characteristics in the capital market, like fixed income market, that would kind of like more relying on CRA's signals? Who are the
I see.
audience or the participants kind of relying on these signals? And
Okay,
why?
I'll try. Yeah, I'll try my best to answer, and then if I miss anything, Shiheng, please go ahead and help me with that. My understanding is that if you are targeting a public market, then you almost for sure will need a credit rating, and that's the most important reason. And if you're trying to broaden your appeals to on the debt market, so you will need a CRA. Yeah. Shiheng, are you aware that if you are also, let's say, if you're only borrowing on the private market, would you need that?
I don't think so. In the US, I think it's regulated and whenever firm issue public bond, you must get a credit rating. But only credit rating agencies may issue ratings if firm do not elicit. But a firm will not say approach credit rating says I do not issue public bond, but I do want a rating. We do not have that kind of case. No.
Yeah. Well, recently, I mean, credit rating agencies do issue these private ratings when they're on the private market, but those are not public ratings. So firms can purchase them, they can use them in their lending processes, in their borrowing processes, but they do not have to release that information. So even if a firm approach a credit rating agency and the credit rating agency give a rating, the firm can still choose not to use that. And the credit rating agency, they sometimes they will just not release a rating. That has happened. All right. Hi, Bugua. All right. Next one is the implementation. So in terms of the differences between the debt covenants and the rating reports and the rating thresholds, private debt covenants are often ad hoc. They are based on different type of financial ratios or and the calculation of the ratios could be different, and they do not have a uniform measurement. So think of them as just a negotiation between the creditors and the borrowers. Think of it as managerial accounting. You don't have to be subject to any rules. But credit rating agencies here, they maintain consistencies in both the measurements and the ratios, and also the settings of the thresholds across firms within the same industry and rating levels. So I'll show you in a little bit of how the credit rating agencies are calculating these two core ratios that we look at. So for our study, we extract the reports from the S&P, and then we try to extract the rating downgrades thresholds from the S&P reports from the text or in the Outlook session. So specifically, if we look at this report over here, we'll see that their ratio threshold is leverage were to remain above 6 times or higher, or FFO to debt were to drop to below 12% on permanent basis. Now, in our study, we use a large language model, Grok 2, and we asked the Grok 2 to basically extract these ratios from the thresholds downside scenarios. And we also try to validate that measure by choosing a random sample of 200 reports. And we found that Grok 2 was able to achieve about 98% accuracy in attracting the correct downside thresholds of these ratios. Now, other than the financial thresholds that we use, we also have the actual financial ratios that S&P use. So S&P make a number of adjustments to the ratios before they compare the ratios and analyze the ratios. So these two are the, I'm going to give you a few examples of the ratios here. So for example, for the debt number that they use, they started with the short-term debt and long-term debt of the companies, and then they make a very large number of adjustments. So you can ignore the numbers over here. They're not like numerical numbers. They're more of identifiers. If you remember back in the days when we use CompuStat, they have the item numbers. So think of them as the item numbers over there. As you can see, when we look at the financial analyst report, when we look at this adjustment formulas here, there are many things that are included in financial accounting framework that they include in long-term debt and short-term debt that the credit analysts or that at least the credit rating agencies do not believe that they should be the relevant number to use during the process of evaluating a company's credit rating worthiness. We also have the ratios here. We also have the numbers over here for EBITDA. They started with the income, EBITDA pre-adjusting number, and then they make a very large number of adjustments here and arrive at an adjustment number. So, and similarly, we have the cash flow numbers over here. So it's very important that when we compare whether a company's financial ratios is how different they are with the thresholds and also whether they violate the threshold or not, we have to use the adjusted financial ratios from the S&P. So the way that we measure how tight the financial thresholds are to their current number is very similar to how the debt research have historically evaluated how tight debt covenants are to their current number. So basically, we look at what is the current. So we look at two ratios. There are the core ratios. One of them is debt to EBITDA. Also, I'll use this one as an example here. So for debt to EBITDA, we use the current level of debt to EBITDA, subtract the thresholds from that we extracted from the credit rating and reports, and then we divided that by basically the volatility or historical volatility of this ratio here. So to put it in a numerical sense, let's say that the current level of debt to EBITDA is 3.5, and the company has a ratio threshold of 5. So the difference between them divided by the standard deviation, that will be how tight it is. So we structure the measure here, we define the measure here such that a higher number means a tighter ratio. So a higher number means that, or a larger number means that the company's current ratio is closer to the threshold, closer to violating the thresholds. And the other ratio that we use are FFO to debt. So these two, debt to EBITDA and FFO to debt, are the two core financial ratios that we use in the study here. And we rely on them because the vast majority of the rating thresholds are based on these two ratios. We also try to extract some of the other ratios. And if I remember correctly, none of the other ratios appear in more than 10% of the credit rating reports. In our sensitivity test, we also look at a couple of ways to vary the definitions of this ratio here. So for example, we scaled it not by the standard deviation of the measure, but by the threshold itself. And we find similar results in our empirical analysis. We also try to exclude some of the carryover thresholds. So we only use the most recent thresholds, and we disregard the thresholds that were issued more than a year ago. And also we find similar results here. In terms of the sample, so once we have the financial thresholds, the adjusted ratios, we also need to use the ratings from the reports, ratings from S&P. And our sample period is about 2008 to 2020. And starting the sample period from 2008 is mostly because before that, there were very few analyst credit rating reports with these ratios, less than 10%. So in the end, our sample ends up with about 1,331 non-financial firms. They are U.S. firms and about 9,900 firm years. Okay. So, as the first part, we look at what are the prevalence of the ratios. And here we are dividing it by industry that are classified by S&P. And we're looking at what percentage of the reports are issued for what percentage of the firm years within this industry have one of the two ratios. So the first thing that we notice here is that there's a huge, not every industry would have the same number of prevalence of the ratios. Some ratios are more prevalent in some industries and other ratios are more prevalent in other industries. So the ones in red that we are highlighting in the ones in the red box here are the ones that they are much more likely to use a debt to EBITDA ratio and less likely to use the FFO to debt ratio. Home building is one of the classic example here that all the reports we include debt to EBITDA ratio. Very few, zero reports includes FFO to debt ratio. And if you look at the other ratios here, the ones in blue, they have a much higher proportion of reports with FFO to debt and a very low proportion of reports with the debt to EBITDA ratio. So
Alan, I have a question here. Is there any reason why they have a preference for different ratios?
I think that that indicates how useful a certain ratio are in calculating the creditworthiness of firms in that particular industry. So that's what I believe in. Yeah. Bugua, do you have anything to supplement here other than the industry?
Yeah, I think it goes in part to also whether the ratio is well defined or not. Like in some industries, the ratio may not be necessarily well defined for some of the firms. Like if you're a company that keeps running negative FFO, then the analysts may decide not to basically set a threshold based on an unreasonable number.
Ayang?
Hi, Alan, and everybody. I have a question. So like usually when the presenter come to this table, they would have told us what's their research question. And I guess that this is a very cool data set, so I may have missed it, but like, what's the purpose of diving into one entity's consistent uniform standards across different firms and industries? Like, what's the underlying questions you want to get at?
So our question, our research question is what determines the ratio? And does that change? What determines whether credit rating agencies, how credit rating agencies set this ratio thresholds, and what are the consequences of this ratio thresholds? So basically, how does that affect the company's behavior in these ratios?
Thank you.
Yeah. So actually, that's the first point here. How do credit rating agencies determine the ratio? That's our first research question here. So it's a rather, I would say, a rather descriptive paper. So we're trying to understand. We're the first one to. We found that we are the first one to identify these ratios. So we start with a descriptive question of how actually credit rating agencies set these ratio thresholds. So in addition to the cross-industry differences here, we can also see that credit rating agencies also set the ratios according to how creditworthiness the companies are. So we have different levels. We separate it by the rating levels of the companies. So as you can see here, when the ratio, well, very intuitively, when for EBITDA ratio, for example, if you have worse credit ratings, the ratio itself is going to be higher. Okay, and then also the threshold itself is also going to be higher. And interestingly, if you look at last column over here, how tight the ratios are, it seems like that for the companies with better credit ratings, they are given a looser thresholds. Okay, they're giving a looser thresholds, meaning that their threshold are further away from their current level compared to the credit ratings, compared to the companies receiving worse ratios here, worse credit rating levels now. And we see the same patterns here for the FFO to debt ratio. Now, when we look at, so these are sort of univariate results, then we look at the regression results and try to see what explains the thresholds. Now, as we talked about before, credit rating agencies set it based on which industry they're in and credit rate and also the level of the ratings. So we try to see whether this is only a mechanical process, whether credit rating agencies directly just determine that based on which industry they're in, their rating levels, etc. Now, if that's the case, then we should see that the R square from this threshold by the rating and also the industry fixed effect would have a very high R square. So over here, we separately look at the two ratios here. And we include either the rating fixed effects, the industry fixed effects, and also the rating times industry fixed effects. So a couple of things that we notice here. First is that for the rating fixed effects, rating levels seems to play a larger role in explaining the thresholds in credit ratings in firms that receive more speculative credit ratings. So means that if you're investment grade, meaning that your credit rating is quite good, then your rating levels doesn't really matter as much. So for example, if you're AAA versus AA, it doesn't matter as much. But if you are BB versus CCC, then it matters a lot in explaining your thresholds. And within the investment grade, so within the ones with high investment, with high credit worthiness, which industry you are in matters a lot. Okay, so for the ones with really good credit, for the ones with better credit ratings, which industry you are in matters a lot to how close the thresholds are to your current threshold, to your current ratio level. But even if you combine the two here, if you look at the rating times industry fixed effects, which should explain all of the variations, if these thresholds are mainly mainly determined by formulas by S&P, it only explains about 2/3 of the variations in these ratios. And year fixed effects almost explains nothing. So basically, it seems like there's no change in their methodology over time, or that it's already captured by by both the ratings. So by both the thresholds and the ratio, so that their differences are not varying across years. Now, next we look at some firm characteristics and see whether they predict the ratios thresholds tightness. So we have a few predictions here. One of them, the first one is based on financial health. We predict that for the ones with better financial health, because the monitoring cost, because credit rating agencies should believe that these are the better credit rating credit worthiness firms. They do not need as much monitoring, so we should put them on a looser list. So they shouldn't need to have tighter thresholds. For the ones with investment opportunities, because they may need more flexibility in trying to in their investments, in borrowings, so we shouldn't put them on a tighter list. And for the ones with higher uncertainties, because they're more risky, they need more monitoring, we need to have tighter thresholds. And the last one over here is with credit rating agency incentives. So basically, if they have more, because of the issuer pay model, if credit rating agencies need to cater to the clients, they should give the clients a looser threshold, a less tight threshold. Ayang, go ahead.
Yeah, I have two questions about your hypothesis. The first one is related to the financial health. So in the private loan contract literature, we knew that at origination, lenders tend to actually negotiate a kind of like tighter covenants for riskier borrowers. And so here for public debt issuance, once the issuer has the credit rating from S&P, S&P will actually obligate it to continue updated, right? As long as that public bond is still outstanding. So is there any, so here that your hypothesis is not limited to just origination, the initial issuance, it also kind of applies to all the subsequent updates. Whenever new information, I just try to kind of figure out the different structures and how does this hypothesis differ from that private loan setting. So that's my first question.
Yeah. So think of this as that almost every year, the S&P will issue reports. They would update their credit ratings and credit worthiness, and we are looking at the tightness of the thresholds within that reports. So we are looking at what the company's financial health is up to that moment.
Okay.
So it's not
kind of annually.
yeah, it's continuous. Yeah, it's not directly tied to a particular debt issuance. And of course, after debt issue, rating agencies usually, unless there's some events, otherwise they would review the credit ratings every year. So you can think of these as including the initial ones, and also the subsequent updates.
Okay, so it's an entity or it's a company level.
Yeah,
It's not
yeah,
a facility
yeah.
level credit
That's
rating.
right. Yes. It's entity level. Yes.
My second question is more related to asset pricing. It seems to be your second and the third hypothesis seem to be that company may have positive investment opportunities without actually getting a lot of risks. So in asset pricing, I think in the extreme efficient market hypothesis, whenever you are going to earn higher returns, it always come with a higher risks. So your second and the third hypothesis have the opposite sign. I assuming that you try to somehow decompose this into two components. Somehow investment opportunities are going to generate future cash flows or benefits to the firm, but holding constant uncertainty only captures the risk aspect. Is that what you have in mind? Otherwise, it will be like how could it possible like generating future opportunities without taking risk?
Yeah, that's a good point. I think that empirically, we use two sets of variables to measure them. So you can think of that we are holding investment opportunity constant and looking at uncertainties, and holding uncertainty constant and looking at investment opportunities. But there definitely are correlations between them, that negative correlations between them. So their prediction could be different. For one set of firms, let's say that if they have higher investment opportunity, the uncertainty may be higher. Yes, correct. Yeah. Okay. So empirically, we try to use a large set of variables to capture these concepts in our empirical predictions. And so for the first one here, for financial health, we use their interest rate coverage, profit margin, the level of their cash, and also the leverage here. And we overall, not every single one of them are significant, but we see patterns that are consistent with our predictions. So for companies with better financial health, their thresholds are less tight compared to companies with worse financial health. For investment opportunities, we look at their capex, we look at whether they are issuing bonds, and then we also look at whether they are their market to book ratio as well. In the sense that when they have higher market to book ratio and higher capex, they have more investment opportunities. And we also find results that are largely consistent with our predictions, that for the firms with higher, or at least the market believe that they have high investment opportunities, they'll also have looser thresholds. And next, we look at the volatility side, and as you can see, most of the measures here are based on their return volatilities, BR spreads, capital market measures. We also have earnings volatilities here as well, and we have some indication, we have some results that when the volatilities are higher, when the firms have more volatile stock price, more volatile earnings, etc., they are put on a tighter leash. So their thresholds are tighter, meaning that it's closer to their current level of ratios. And we also in these regressions, we also, some of them don't include fixed effects in the first column here, and we also progressively try to add more fixed effects, including firm year fixed effects, and we find very similar results across the fixed effect structures here. And we also find similar results with investment grade and speculative grades bonds separately, rated firms separately. And lastly, we look at the credit rating agencies analysts in this hypothesis. We look at how important the clients are to the credit rating agencies. We look at whether this is a major client, so based on the size of the client's revenue to the size of the clients to the credit rating agency's overall portfolio. And we also look at the competitions from the third credit rating agencies, the third largest credit rating agencies, Fitch, within the industries. And we find that when when credit rating agencies face higher competitions or that the clients are more important, they give a looser thresholds to the rated companies. Tomomi?
Yes, hi. Thank you very much for your interesting presentation. So very minor clarification. So I wonder if credit rating agencies determine the threshold first, or by observing the target company's financial ratios, they modify the threshold. So I wonder if which determines in what kind of situations, what is your assumption regarding how credit rating agencies determine the threshold?
I think they take into all. I think my prior is that they take all information into consideration when determining a ratio. When determining their thresholds. So it's not a mechanical format that they just determine the ratio regardless of what the current determine the threshold regardless of what the current ratio is. That's my prior.
So does it mean that, so because of that, year fixed effect, year impact does not matter in your model? For example, so the credit agency understand the economic situation in a particular year. So therefore, they taken into consideration about the entire market condition and modify the threshold. Because of that, so the year effect, so the entire market condition may not impact the tightness of threshold. Am I right?
Right. In some sense, yes. So for example, if this year is good, then it should be reflected in the ratio already. So when I set the threshold, the difference between the threshold and the ratio is not really affected by the year fixed effects. That's my, yeah.
Okay, I see. Thank you. Thank you very much.
Okay, sure. Ayang?
So can you help us understand how does this adjusted R squared here compare to your earlier core result about fixed effect? You try all the different fixed effect and show R squared is very high. It's already 2/3. That is a pretty good determinant model. And then here is, are those kind of within?
I see what you're talking about. Yeah.
Yeah.
So here we are looking at the thresholds as a dependent variable. And over here, we're looking at how tightness the thresholds are. So basically how close the threshold is to the current ratio.
Oh,
So there
okay.
are different dependent variables.
Oh, okay. And why
Yeah,
so if you have tightness in the previous exercise,
so one is the first one is looking at this one as the adjusted the R square table is looking at this one as the how they set the thresholds, and over here we're looking at tightness of the thresholds.
okay, because the tightness has two components. The issuers itself has that contribution to the tightness, and then also the threshold set by the S&P. But the
That's right,
threshold
yes.
is only by the S&P, right? And then I think that's why Tomomi was asking that whether the S&P consider kind of like pick ahead the company issuers ratio when they kind of set or modify
Well,
the threshold.
the issuer has a ratio. It's not peeking ahead. The issuer has a ratio right now, so they're determining a threshold based on the current ratio. So if the economy is not good, then the current ratio is bad over here, and the threshold could be adjusted to account for that. Right. Now, if we want to run a regression of the threshold over here as the dependent variable, then threshold, yeah, then we also would need the current ratios as one of the independent variables to control for that. right? Okay. All right, so this is basically our first research question. Now the second research question that we look at is once the threshold is released, how do issuers, so basically the issuers now know that they have this target, they know that if they violate this target, something bad would happen, or at least something bad is more likely to happen. Do they actually respond to the ratios? So we look at the research question is whether tighter ratios are associated with tighter thresholds are associated with improved ratios. So the first regression that we look at we just look at a change in the ratios and regress that on how tight the thresholds are. So the change in the ratios are change in the two core ratios. Sorry for the changing the slides. And here we control for the rating industry fixed effects, year fixed effects, and also the firm characteristics that we included in the previous regression. And over here, the main variable of interest is the tightness measure here. So we see that the tighter the ratios are, the more likely that the firm would actually improve that ratio. So for the FFO to debt, the lower the ratio are, the healthier the firm is. For FFO to debt, the higher the ratios are, the healthier the firm is. So basically, when you face a tighter thresholds, you are more likely to improve on that ratio. And we see that the effect is stronger for the speculative grades than for the investment grades, at least for the debt to EBITDA ratio here. So this is a correlation between the tightness of the ratios and the tightness of the thresholds and the improved ratios. But we also want to see whether this improvement is actually driven by how tight the ratios are. So we want to tell the causality story. So is this really the thresholds? So we borrowed the literature from many years ago, looking at the discontinuity or the kink in the distributions. So here we plot the histogram of adjusted financial ratios around the actual threshold number. Now this over here, the peak over here is 0. So this is the point that if you're to the left side of the ratios, to the left side of this bar here, you're breaching the thresholds. To the right side, you're not breaching the thresholds. So as you can see, there's a significant increase in the proportion of firms or in the number of firms that are exactly at 0 compared to a negative number breaching the thresholds. So this clear discontinuity means that firms are actively trying to avoid breaching the thresholds that are issued by S&P. Okay. Now, next, we also tried a pseudo thresholds. So try to see if the discontinuity also exists if the firms are if we use something that S&P would have disclosed and used, but is not actually used. So for the pseudo thresholds, we use the rating industry years average thresholds, and we do not find any discontinuities here. Okay, so for this one, the Macquarie density test showed no discontinuity in around the threshold or breaching the ratios. Now, next we take a look at the specific actions that the rated firms take to improve the ratio. So we see improved ratio already, but how do they actually improve the ratios? Now, if they want to improve the ratios, if you look at FFO to debt, etc., they have two ways to improve the ratios. One of them is to reduce the leverage. The other one is to increase the operating metrics. So in short, we find results in both. We find that they are likely to reduce the leverage and also reduce the leverage and improve the operating metrics. For reducing the leverage, we find that when the ratios are tighter, they are less likely to issue debt. And the results are also stronger for speculative grade compared to investment grade. That's likely because for the firms that are in speculative grades, every actual downgrade is more costly to them. So they are more likely to have trouble borrowing from the market when they face negative rating actions. So they want to avoid these negative rating actions. So they have more incentive to avoid breaching the threshold here. We also also look at the net equity issuance, and we find similar results that so basically when the firms have problems or they want to avoid issuing debt, they reduces their net equity issuance. And some subsample tests find that these results is driven by firms less likely to repurchase shares rather than new equity issuance here. We also look at the operating results. So we look at two operating results. One of them is sales growth, and the other one is a change in EBITDA. And we find that when firms face tighter thresholds, not only do they try to reduce leverage, but they also improve their operating metrics. So including sales growth and also the change in EBITDA here. And we find the results are similar to the previous case of the reducing leverage. The results are stronger whenever firms have speculative grades rather than investment grade ratings at the moment. Okay, and so after we look at Ayang, go ahead.
Oh, do you want to finish your results first?
Go ahead. No, it's okay.
Yeah, sorry. My question is still related to earlier when you talk about the timing, how you calculate the tightness. So I look at the paper, the tightness is defined as the year-end actual ratio minus the earliest of the threshold in the following year. Is that how you calculate the threshold? So I think one placebo test is have you explored kind of changing that timing? Because that's potentially the threshold is set after the issuer already know the actual threshold and then somehow can privately communicate it with the credit rating agency they hire. So if I try to kind of think about usually those tightness or threshold is kind of in the financial analyst literature, we try to capture the realization that actually is a surprise to the threshold or analyst expectation that was ex ante set. Everybody know about it. But in this case, I feel like the tightness will be the threshold actually comes at the same time or maybe after the realization of that year's financial ratio. So the company already know their debt to EBITDA ratio after the fiscal year end, and they can privately communicate with S&P, and then the threshold is modified or set. Or maybe those two things actually happen concurrently. But it's very different from you set the threshold and realization happen later and people try to meet your ex ante predetermined.
Actually, in our case, they so think of it this case that the year T-1 is done. The financial reports are released. S&P has the reports already. S&P know what your current ratio are. S&P is issuing a threshold, and that threshold is for future years.
Oh, so they don't modify their threshold? It's like somehow
what do you mean by modify? Well, last year there was a ratio threshold as well, but last year it was for the year, it was using the year before as the benchmark. So think of every threshold that they issue here is for future years.
Okay.
Yeah.
Then you should compare to the future years' actual financial ratios, not the historical year financial ratio.
Well, I
to
think
calculate the tightness. Yeah.
I think that for the tightness literature, for the debt covenant tightness, if I remember correctly, they are also comparing it with the current level, not the future realization.
Okay.
So based on what basically they are issuing the information based on what they have at, they're issuing the threshold based on what they know at the moment.
Okay. All right.
Alan,
Yeah.
sorry.
Yeah, if it's too
Holly-
complicated, you can ignore it. If this is not a common thing, considering the literature, you can ignore it. It's just like, I try to kind of think about the timing and all
Okay.
those different
All right.
parties
Okay.
at play. Yeah.
Alan, I have a question here. As you mentioned that S&P actually calculate out the ratings and also the threshold. And the model that we use Winsorite results. Do they use similar method mechanically to address the outlier issues at their end before they churn out the ratings and also thresholds?
Well, in our empirical analysis here, we use winsorized results. I do not believe S&P winsorized anything when they are using the ratios. I believe that if they're I think that when S&P calculate the ratios, they use the exact measures of that ratio following the formula that I showed earlier in the presentation. I don't think that they winsorize anything.
Have you spoken to them about that?
I have not asked. I have spoken to S&P. I have not asked them that specific question.
Okay, all right, no problem.
Yeah. All right. So the next one that we look at is so knowing that they do try to take actions to avoid breaching a ratio, are they more likely to breach? Are they still more likely to breach ratio when they face tighter thresholds? And we find the results are yes. So if you are issuer, if you're facing a tighter thresholds, even though you have taken actions, you are more likely to reduce your leverage, you are more likely to improve your operating performance, but in the end, they are not sufficient to completely counteract the tighter thresholds, so that you're still more likely to breach the thresholds. So there's about a 3 to 9% increase in the violation likelihood here, relative to the unconditional likelihood of about 22 to 23%. So that's quite economically significant. So the last research question that we look at is how credit rating agencies respond to the ratio breaches. So we separate our sample into two. One is a breach sample, one is a non-breach sample. So back to your question here. So this is the actual results that they release the year later. Okay, so basically you're looking at year T-1, year T-1 is done. So we know the actual ratio for the previous years. We release a threshold right now. And then year T, so basically a few months later, the firm have another financial reports. And based on that financial report, we can calculate the updated ratios and whether that updated ratio breached the thresholds here. So we separate it into two samples. One of them is breach sample, one of them is non-breach sample. The most important results, now obviously intuitively, for the ones that are breached, you see that the ratios get worse, right, in terms of credit ratings. So the debt to EBITDA ratio increases, the FFO to debt ratios are lower for decreases for the breach sample relative to non-breach sample. But if you look at and a couple of other things. One is that for the ones that are breaching this year, they're also more likely to breach in future years as well. There's a 50% chance of if you breach this year, conditional on that, you're going to breach the thresholds in the next couple of years as well, T+1 to T+3. And if you look at the negative rating actions, that's why we think of when we compare the credit rating reports thresholds with the debt covenants. For debt covenants, it's a binding contract, and for this one, it's more like a soft threshold, a soft target. Even if you don't breach it, you have a 15% chance of receiving negative actions. If you breach it, your chances of receiving negative actions significantly increase, but it doubles, but it's only 31%. So there is a non-trivial number of cases that even if you breach the thresholds in one single year, the credit rating agencies are not downgrading your stocks or not downgrading your credit ratings or taking negative rating actions. So we run a regression here where we control for the firm characteristics, we control for the rating industry fixed effects, we control for year fixed effects, and also importantly, we also control for the change in the two core ratios itself. So basically over here, we are looking at a threshold effect. So controlling for how much change there are for the two core ratios, breaching the thresholds is significantly increasing the chance of negative rating actions. And importantly, it's not just the breaching the thresholds this year, but also breaching the thresholds in the future years as well. So the threshold over here, even though it's a soft ratio, at least it carries some teeth. The credit rating agencies do follow through in some cases when the firms breach their thresholds and they're taking negative actions. In one additional test, we also look at how severely the firm have breached the thresholds. So we look at the magnitude of the breaches, and we see that when the firm are more breaching the threshold to a larger magnitudes, there's a higher likelihood of negative rating actions as well. We also try to look at the severity of the breach using whether they're breaching two thresholds in 1 year or just one of the thresholds, and we find that when we don't include the future breach likelihood, the only thing that breaching both have a additional effect on the penalty of negative rating actions compared to breaching one. But when we control for future, then it doesn't matter as much. And if you look at the coefficients of the two variables here, future breaches are even more important than breaching in 1 year. So I know you probably don't remember, but in the example that I gave initially, when we look at the outlooks for the American tower companies, they talk about when firms are breaching the ratios on a permanent basis. So for the credit rating agencies, whether this is just a one-time, 1 year event versus whether it's a more permanent decrease in your credit worthiness is something that they consider a lot when they're trying to determine what your credit ratings are. We separated results into investment grade and speculative grades, and we find that the results are similar in both. Basically, the two set of results that we documented earlier apply in both settings here. So the last research question we look at is how do investors interpret the ratios? So here we have two-sided predictions. One of them is the tighter ratios means that credit rating agencies are monitoring the companies more closely, so it should lower the agency cost. So there should be a favorable response. But also at the same time, tighter ratios also indicates less financial flexibility. So maybe the credit rating agencies have some private information about negative outlooks. That's why they issue a tighter thresholds, so the investors will view them unfavorably. And overall, we find that the results are negative. So we look at the bond market returns. It's negatively associated with how tight the thresholds are. And we also look at the equity market responses in the 3 days surrounding the credit reports that includes the ratios, and we find similar results there as well. So controlling for every other information that we can find from credit rating reports, tighter ratios, investors usually interpret that as bad news. So to summarize, we provide the first systematic evidence on the financial thresholds. We go beyond the headline ratings to examine the quantitative signals that are embedded in the process. That it's a very important use of accounting information within the credit rating process. And we also introduce another external benchmark, a soft constraint that credit rating agencies use to coordinate with the investors on the market and influence corporate actions. Thank you very much. If you have any additional questions.
Yeah, Alan.
Alan, do you have the next event?
Yeah. Paul?
Yeah,
Please.
Alan.
Yeah.
Yeah, thank you. It was really interesting. Thanks for the presentation. Just generally, I would have thought that issuing these sort of tighter constraints is going to add more protection to the creditors, all right, to the bondholders and so forth. And so that protection is essentially a sort of a shift in control rights from the equities to the bondholders. And so normally a shift in control rights that protects should be beneficial for those groups. Yet you're showing that there's a negative impact. So have you thought about how you might resolve that? I mean, just in terms of, kind of the theory would suggest a more positive response from the credit side.
Yeah.
Right.
So we think of it as that if you look at the hypothesis that we had earlier on the investment opportunities, etc., when the credit rating agencies see that you have better investment opportunities, they will give you a looser thresholds. So it could be that these tighter thresholds actually reflect some private information about negative outlooks. So that's driving how tight the thresholds are. and the investors are looking at thresholds like, why do you issue a tighter threshold to begin with? That's something maybe you know about the company that I don't know about, so I'm going to react negative to that. They're extracting the information from that. So rather than the monitoring part. So I 100% agree with you that the monitoring part, definitely a better monitoring, shift the right from equity holders to creditors. So creditors should like that. Yes.
Okay, so just a final sort of broader point. S&P obviously spends a lot of time and effort in developing these thresholds, right? And they seem to be market sensitive. So the question is, who's actually paying to have all of this done? How does S&P recover the cost of doing all this work?
Well, the short answer is that it's an issue of pay model. So it's the company that are issuing bonds. They are paying for S&P. Now, I believe that for rating agencies, they may internally already have some threshold to begin with. It's just that in the past, it's probably more opaque and they chose not to disclose them. And after the financial crisis, because of all the call on transparency, they are more of a force to disclose these ratios. So it was always used in the rating process in some sense. We know that they use ratios in the rating process, but we just didn't know what the actual thresholds are. But after 2008 and 2009, they start to disclose these thresholds. That's what we observe in the data here.
Okay, and then does Moody's do the same thing, or do they time it around the same time, or is the timing with the other major agency different or the same?
I believe Moody do the same thing as well. We only have data from S&P, so that's what we study here. Historically, we look at just the correlation between the correlation between the ratios of the two. The credit rating itself, I think, is about 90, 95, 98, 99% correlated. So whatever threshold that they use, at least the outcome are very, very correlated between the two.
The two, okay.
Between the two major ones, yes.
Okay,
And,
that's it. Done. Thank you.
Okay, thank you. And I need to also introduce the next virtual event. Ayang, do you want to say this or?
No, I think the next event will be Katie Lam from Ohio State. We will come back to kind of our earlier time, but a little bit 1 hour earlier than usual. So I'm going to stop recording and